Okay, let's dive into this. In a world just saturated with buzzwords like AI and 5G, where do we even start to cut through the noise to find where the real innovation and value actually lie? Welcome, discerning listeners, to The Deep Dive. We're brought to you by Market Insight Cast, your go-to YouTube channel, really, for piercing through all that market complexity to find clarity and hopefully some actionable insights. We take your articles, your research, sometimes even your own notes, and we try to distill the most important nuggets of knowledge, giving you a shortcut to being truly well-informed. Today, we're taking a deep dive into a tech titan, one that maybe for many often operates kind of quietly behind the scenes, yet is absolutely fundamental to the digital world we all live in: Qualcomm. Ticker symbol QCOMM. We compiled some really fascinating sources, recent earnings call summaries, detailed financial reports, some in-depth business analyses to really dissect their latest Q2 fiscal 2025 performance, understand their evolving business model, and project what their future looks like in this increasingly connected world.
That's right. And our mission today is, well, it's to equip you with a truly holistic understanding of Qualcomm, moving beyond just the headlines and those single data points you might see flying around. We'll explore their recent financial health, critically examine their strategic pivots into these new high-growth markets like automotive and AI PCs, and importantly, confront the significant challenges they undeniably face. Our aim is really to connect the dots for you, offering both an optimistic view and a rigorously cautious perspective on where this company stands today and, where its trajectory might lead in the coming years.
Exactly. And to do that, we're going to approach this with a bit of a strategic debate, you could say. My reading of the data honestly highlights some truly compelling opportunities and strategic successes. They paint a very optimistic picture of Qualcomm's trajectory, I think. So I'll be focusing on those powerful growth engines and the strategic wins that, to me, suggest a pretty robust future.
And I, in turn, will be examining the potential headwinds, the competitive pressures, the inherent uncertainties that, from my perspective, well, they warrant a more prudent and cautious assessment. It's absolutely crucial that we scrutinize every angle and maybe challenge every assumption, especially when you're dealing with these dynamic, fast-evolving tech markets.
Okay, let's begin then. Let's unpack Qualcomm's foundational identity and its unique dual-engine business model. This company, founded way back in 1985, they didn't just stumble into wireless. They created so much of its modern infrastructure. Their early innovation, the Code Division Multiple Access, or CDMA technology, that wasn't just some technical achievement. It laid the very groundwork for 3G and then 4G networks globally. Think about that for a second. They were instrumental, truly instrumental, in setting the standards that billions, literally billions, of mobile connections now rely on. It's a testament to their foundational role as an inventor, a standard setter in wireless comms. In fact, their very first commercial product, launched way back in 1989, it wasn't even a phone chip. It was the on-a-tray Cree satellite communication system. Remember that? Mostly used by trucking companies for fleet tracking and management. That demonstrated their early prowess in robust, critical wireless data transfer, establishing them as a serious, innovative player right from the start. Fast forward to today, and their Snapdragon line of processors. Well, they didn't just become industry staples for mobile devices. They became synonymous with that high-performance premium Android experience. This isn't just about adapting. It's about consistently being at the forefront of technological breakthroughs for decades, really leveraging their deep R&D roots.
And what's fascinating here, I think, is how Qualcomm actually structured its revenue generation. It's primarily through two distinct yet kind of interdependent major segments. First, you have Qualcomm CDMA Technologies, or QCT, that's their chip business, basically. And second, Qualcomm Technology Licensing, or QTL. They're immensely profitable patent licensing arm. Now, while this dual-engine approach might initially seem like it provides robust diversification, if you look a bit closer at the distribution, it actually reveals a pretty significant concentration. In fiscal year 2023, QCT, the chip selling part, contributed a substantial 85% of total revenue. 85%. And within QCT, a considerable 63% of that revenue was still derived solely from the handset business. Phones. So this heavy reliance on a single product category, despite these ongoing diversification efforts we hear about, it immediately raises an important question, doesn't it, about their inherent dependencies and vulnerabilities to the cyclical nature and competitive pressures of that mobile market. Just to clarify for our discussion, QCT is where Qualcomm sells its physical products and services. This includes, their renowned Snapdragon chipsets, powering everything from premium smartphones to emerging automotive systems and a huge range of Internet of Things or IoT applications. On the other hand, QTL operates as their intellectual property powerhouse. This segment generates revenue purely from licensing fees. They hold this vast foundational portfolio of patents covering critical wireless standards like CDMA, WCDMA, OFDMA, and the essential tech underpinning 3G, 4G, and 5G. This lets them collect royalties on, well, virtually every device shipment globally that uses their patented technologies, often without having to actually manufacture a single component themselves. It's an incredibly high-margin business, no doubt. But it's also one that's faced considerable legal scrutiny and global regulatory challenges over its history. That's worth remembering.
Right, but I think this business model is about much more than just selling physical chips and licensing IP. It's about fundamentally enabling and really accelerating the entire technology industry. Qualcomm isn't just a component supplier, in my view. They are the indispensable building blocks. They provide the very infrastructure and innovation upon which our connected world is built. For mobile device manufacturers, they offer not just high performance, but exceptionally energy-efficient processors with advanced features like cutting-edge 5G and increasingly powerful on-device AI capabilities. These are the brains making modern smartphones not just work, but really excel, delivering sophisticated user experiences. For wireless carriers, their contributions go beyond chips to advanced network infrastructure solutions, enabling faster, more reliable, secure connectivity. Crucial for their vast customer bases, they provide the foundational tech for the networks powering our digital lives. And for the rapidly expanding Internet of Things, or IoT, device manufacturers, well, the comprehensive range of connectivity solutions, from modems to Wi-Fi, Bluetooth, cellular, along with powerful, energy-efficient processors and robust software development kits, SDKs. These SDKs empower developers to create highly efficient, reliable IoT devices, from smart home gadgets and wearables to complex industrial sensors and smart city infrastructure. They are, in essence, the underlying enablers. They allow countless other companies to innovate, scale, deliver new products, truly driving human progress across major industries. Their mission statement says it clearly: to invent breakthrough technologies that transform how the world connects, computes, and communicates. They don't just participate, they actively invent the future, and they achieve this through strategic, long-standing partnerships with all these key players: carriers, smartphone makers, other tech companies, even universities and research institutions, fostering this collaborative ecosystem of continuous innovation. Okay, now let's turn our attention to the financial results.
Because here's where the true story of Qualcomm's strategic shifts and operational strengths really comes to focus, I think. Qualcomm's Q2 fiscal 2025 results, announced back on April 30th, were genuinely robust, significantly exceeding market expectations across the board. Non-GAAP revenues hit an impressive $10.8 billion, with non-GAAP earnings per share, or EPS, at a solid $2.85. Now, this wasn't just incremental growth. It was a powerful testament to their ability to execute effectively in what is, let's face it, a complex market, demonstrating strong operational performance that actually surpassed their own guidance midpoint. Looking at the GAAP figures, the generally accepted accounting principles, they recorded revenues of $11.0 billion. That's a significant 17% increase year over year. And GAAP EPS was up 22% at $2.52. These numbers, they signal a company confidently navigating the current economic environment and successfully finding pathways to strong, profitable financial performance. Diving deeper into their core chip business, QCT delivered revenues of $9.5 billion, and they maintained an impressive non-GAAP EBT margin of 30%.
Which really highlights the continued profitability and efficiency in their chip-selling segment. And what's truly remarkable, I think, especially for investors, is their unwavering commitment to shareholders. Qualcomm returned a substantial $2.7 billion to shareholders in Q2 alone. That included $938 million in consistent cash dividends and $1.7 billion in strategic stock repurchases. More tellingly, perhaps, they've explicitly committed to returning 100% of their free cash flow to shareholders in fiscal year 2025. 100%. That's a powerful vote of confidence from management, isn't it? Signaling their strong belief in the company's current financial health, its ongoing operational efficiency, and its long-term cash-generating ability from both established and emerging business lines.
While those overall top-line numbers certainly present a positive picture, we really need to delve deeper into the segment performance to understand the nuances and the underlying trends. It's not always straightforward. The QCT handset revenues, their core mobile chip business, yes, they did grow 12% year over year to $6.9 billion. That's true. This growth is primarily attributable to an increase in premium-tier Android shipments. And yes, this is partly due to strategic design wins, like the Snapdragon 8 Elite being exclusively integrated into the Samsung Galaxy S25 series. That's undeniably a significant achievement in the high-end smartphone market. However, If we connect this to the bigger picture, the mobile business itself, well, it has struggled considerably over the past year, and maybe more broadly. We saw a stark 27% year-on-year decline in mobile business revenue for Q4 fiscal year 2023. That directly contributed to Qualcomm experiencing 4 consecutive quarters of overall revenue and EPS decline throughout fiscal year 2023. 4 quarters. So this raises an important question. Is this recent handset growth a sustainable trend? Does it mark a true turnaround for the mobile segment? Or is it perhaps merely a temporary uplift within a mature, deeply cyclical market that could easily revert to declines? Counterpoint data, for instance, indicated the global smartphone market only began showing signs of a rebound in October 2023, and that was after a protracted period of 27 consecutive months of year-over-year declines. 27 months. The sustainability of this upturn remains quite uncertain, I'd say. And a single strong quarter for Qualcomm's mobile chips doesn't just erase the underlying market volatility. Furthermore, in terms of global mobile chipset market share, Qualcomm held 29% in Q2 2023. That put them slightly behind MediaTek's 30%, and it also represented a decrease from their 32% share back in Q2 2022. So while the premium tier win with Samsung is positive, definitely, the broader market dynamics and the fiercely competitive landscape for mobile chips, well, they still present significant headwinds, and I think warrant a cautious outlook on this segment's long-term consistent growth trajectory.
But see, this is precisely where Qualcomm's strategic diversification truly shines. It provides a powerful counter-narrative to any lingering concerns about that mobile market volatility. Their automotive revenues, this segment speaks to the future of transportation. It's skyrocketed by an astounding 59% year-over-year in Q2, reaching an impressive $959 million. This isn't just a fleeting bump. This reflects significantly increased content per vehicle in new launches and the strong, rapidly growing adoption of their Snapdragon Digital Chassis platform across a widening array of automakers. This segment is clearly emerging as a primary engine for predictable, long-term revenue. It offers a stable and high-margin counterweight to the more cyclical consumer phone market. For listeners maybe unfamiliar, the Snapdragon Digital Chassis is a comprehensive suite of solutions. It essentially integrates the entire digital architecture of modern vehicles. Everything from high-performance digital cockpits, robust in-car connectivity, to advanced driver assistance systems, ADS, and even fully autonomous driving capabilities. And to further solidify their leadership in this absolutely crucial space, Qualcomm strategically acquired Autotalks back in June 2025. This pivotal move integrates industry-leading vehicle-to-everything, or V2X, communication technology directly into their automotive portfolio. V2X is absolutely crucial for the future of autonomous driving, enhancing road safety, traffic flow, vehicle communication. Similarly, their Internet of Things, IoT, revenues increased by a robust 27% from the prior year, reaching $1.6 billion. This growth is driven by increasing demand for sophisticated connected devices, advanced processing capabilities at the edge, and the proliferation of on-device AI across various sectors. This demonstrably proves their success in extending their core technology beyond traditional mobile into high-growth, transformative industries like industrial IoT, smart homes, and the burgeoning AI PC market. This isn't just diversification for the sake of it. It's smart strategic positioning in the most dynamic and future-defining sectors of technology.
While the growth in automotive and IoT is indeed promising, yes, we also need to examine the Qualcomm technology licensing, or QTL, business, their patent arm. This segment remains stable at $1.3 billion in Q2. It held a flat year-over-year growth rate and an EBT margin of 70%. 70% margin, very high. Now, while stability in such a highly profitable segment is generally a good thing, especially when other areas are growing, it did experience a slight 1 percentage point decrease in its EBT margin. Small, but notable. Furthermore, its flat performance was largely attributed to the impacts from reduced handset shipments in emerging markets, which indicates a direct linkage, doesn't it, to the very mobile market volatility that QCT is attempting to diversify away from. So if we connect this to the bigger picture, this QTL segment, which historically has been a massive profit driver for Qualcomm, often called a cash cow because of its vast IP portfolio, it isn't showing the same growth momentum as some of their newer QCT segments like automotive and IoT. This raises an important question. Can QTL truly maintain its stability, and especially its exceptionally high profitability, amidst potential challenges to its licensing model? Historically, Qualcomm's licensing practices have faced numerous legal disputes, ongoing scrutiny from regulators globally. That's led to significant fines and shifts in royalty collection methods in various jurisdictions. Additionally, changes in market dynamics, like more device manufacturers developing their own in-house chip solutions, think Apple, or the emergence of alternative licensing frameworks or open standards. While these could potentially impact its long-term revenue potential and maybe even its margin profile. Its flat performance in Q2, while certainly not a decline, it highlights that it's not currently contributing to the company's overall top-line growth story in the same way the diversifying QCT segments are, and it carries its own set of unique risks.
Right. And for those of you maybe analyzing financial reports, digging into company filings, you'll often see this distinction between GAAP and non-GAAP figures. It's probably worth a quick moment just to clarify why companies, including Qualcomm, present both. GAAP, or Generally Accepted Accounting Principles, those are the standard universal rules for financial reporting in the U.S. They provide a common, consistent framework ensuring comparability across different companies. However, companies frequently present non-GAAP measures to highlight what they believe is their core operational performance. They do this by excluding certain items they view as, say, non-recurring, non-cash, or non-operational, which might otherwise kind of obscure the underlying business trends. For Qualcomm, specific exclusions often include elements related to their Qualcomm Strategic Initiatives, or QSI, segmentation. Those are typically their venture capital investments, and their fluctuations aren't really considered part of ongoing core ops. They also typically exclude significant share-based compensation, which is a non-cash expense that can fluctuate quite a bit, and certain acquisition-related items, like amortization of acquired intangible assets or specific costs tied to big mergers. By presenting these non-GAAP figures, Qualcomm aims to provide what they believe is a more comparable and clearer set of financial performance measures, offering, they'd argue, greater transparency for investors by removing these potentially distorting elements. So when we discuss their strong operational performance and impressive growth numbers, particularly for revenue and EPS, it's often these non-GAAP figures that are reflecting their ongoing underlying core business health, giving us maybe a more refined picture of their operational trends. Okay, shifting gears now to future growth engines. Qualcomm is not just, participating in the AI revolution. They are powerfully leading it, I would argue, especially at the edge, defining what on-device AI can truly achieve. They recently unveiled the X85 5G platform. They're calling it the world's most advanced AI-powered modem-to-antenna system. This isn't just about faster internet. It's about infusing sophisticated intelligence directly into the very foundation of mobile communication. This groundbreaking platform is anticipated for rollout in the second half of 2025. Poised to significantly impact not just handsets, but also the rapidly evolving automotive and IoT sectors. Their overarching strategy centers on hybrid AI, which I think is a brilliant and pragmatic approach. It efficiently runs AI directly on edge devices, smartphones, PCs, IoT gadgets, vehicles. This strategic combination leverages the immense computing power of cloud AI for big training tasks, with the distinct advantages of on-device AI for real-time inference. That means faster processing, enhanced data security because data stays local, and deeply personalized user experiences. Their commitment to fostering a robust developer ecosystem is also really clear. Their Qualcomm AI Engine Direct SDK and the Qualcomm AI Hub are rapidly expanding the development environment, empowering developers to optimize and deploy AI models specifically for Qualcomm chipsets, unlocking new capabilities for applications across tons of industries. This proves they're not just selling chips.
They're actively building the foundational infrastructure for next-gen AI applications across countless devices and sectors. Their CEO, Cristiano Amon, he's articulated a powerful vision, emphasizing that AI will fundamentally transform computers, operating systems, applications, even human-computer interfaces. And he's confident Qualcomm will be at the forefront, driving this massive shift. In mobile, their Snapdragon 8 Elite chip has already achieved an impressive 90 flagship design wins globally, highlighting significant success across major Android OEMs, cementing their position in that highly profitable premium tier. Beyond mobile, they've made considerable progress in industrial IoT and PCs, with strategic acquisitions like Edge Impulse enhancing Qualcomm's Edge AI capabilities and significantly expanding the native applications ecosystem. It's a comprehensive, holistic strategy for an AI-powered future, securing their relevance across multiple high-growth domains.
While that ambition in AI and 5G is certainly clear and admirable, entering these new, highly competitive markets like AI PCs, well, it means directly challenging deeply entrenched incumbents. That's never easy. The Snapdragon X Elite processors are indeed making some initial inroads, capturing, as you said, approximately 9% of the premium Windows laptop market in the US and key European countries in Q1 2025. That's promising initial momentum, sure, speaks to their tech prowess. However, the PC market has historically been dominated by players like Intel. Intel doesn't just have a long history, it has decades of deep relationships with PC manufacturers, a vast ecosystem of software optimization, and frankly, formidable developer lock-in around its x86 architecture. That's something Qualcomm's ARM-based X Elite really needs to overcome. Even Broadcom, primarily known for Wi-Fi and Bluetooth chips, has its own processor tech and a strong presence in networking and mobile components, positioning it as a competitor in adjacent spaces. This raises an important question, doesn't it? Can Qualcomm truly sustain this momentum? Can they fundamentally disrupt a market where the competition is so deeply established, with decades of market share and ecosystem control that go way beyond just chip performance? Furthermore, consider their recently announced plan to acquire Alphawave Semi for about $2.4 billion. The stated goal is accelerating expansion into data centers, which is, yes, a huge high-margin market critical for global AI demand, particularly for high-speed connectivity. However, this market will also face fierce competition. Giants like NVIDIA, which totally dominates AI accelerators, and Intel again. Both have considerable resources, established positions, vast customer relationships in high-speed connectivity, and AI acceleration for data centers. It's a bold move, acquiring Alphawave, but one that comes with substantial execution risk and the potential for a very intense, capital-intensive competitive battle. And beyond these new ventures, let's not forget their established competitors in mobile. MediaTek continues to be a formidable challenger, especially in the mid-range and budget segments, constantly pushing on price and market share. Samsung, with its own Exynos processors, competes directly and benefits from deep vertical integration. And of course, Apple, with its aggressive in-house modem development strategy, actively reducing reliance on Qualcomm. That trend significantly impacts Qualcomm's most profitable premium mobile revenue stream. We'll probably touch on that more.
But what's truly fascinating here, I think, is Qualcomm's sophisticated strategic approach to expansion. They're not just aiming to sell more chips. They're integrating deeply into industry ecosystems, building long-term, mutually beneficial relationships that create incredibly sticky and sustainable revenue streams. It's about becoming an indispensable partner, not just a commodity supplier, you see. For instance, their announced collaborations for next-generation AI intelligent cockpit solutions further solidify their leadership in automotive digital solutions. This isn't about a one-off sale. It's about embedding themselves in the fundamental design and long-term evolution of future vehicles, creating multi-year design wins. Their long-standing partnerships are equally impressive, a testament to their core value prop. Take their extended patent licensing agreement with Samsung. That critical agreement covers not just current 3G, 4G, 5G, but even future 6G tech, extending all the way until 2030. That single deal secures a crucial high-margin revenue stream from one of the largest global device manufacturers for years to come. That's huge. Moreover, this partnership with Samsung is actively expanding into automotive infotainment and ADAS systems, demonstrating a clear path to sustained relevance and growth across multiple interconnected critical sectors. They are meticulously building an unshakable presence across critical sectors, securing multiple new contracts in AI-enabled smart devices and the rapidly evolving automotive industry. In automotive specifically, Qualcomm is actively working with industry giants like GM, BMW, Mercedes-Benz, Li Auto, among others. These aren't just names, these are commitments from leading global automakers to integrate Qualcomm's Snapdragon Digital Chassis and other solutions into their future vehicle platforms, indicating deep long-term design pipeline wins. Furthermore, they proactively realigned their IoT strategy, integrated hardware, significantly enhancing their IoT and AI capabilities through strategic acquisitions. You mentioned Edge Impulse that directly bolsters their Edge AI capabilities, absolutely crucial for the distributed intelligence of IoT, enabling on-device machine learning for a vast array of smart devices.
This holistic approach of deep industry integration and strategic partnerships is absolutely key to their long-term growth and resilience in a dynamic market, in my view. Okay, now let's turn to the bull case, because here's where the long-term potential for Qualcomm gets really compelling, I think. The automotive business isn't just a growth driver, it's considered Qualcomm's future growth engine, and for exceptionally good reasons. The company itself projects this market to reach a staggering $100 billion within the next decade, with significant revenue distribution across connected car chips, advanced digital cockpits, and crucial ADAS systems. $100 billion. And here's a truly astounding fact, almost unheard of in such a nascent, high-growth tech market. Qualcomm already holds the undisputed top position as the world's largest automotive chip supplier, commanding an incredible 80% market share according to Counterpoint Research. 80%. Despite only accounting for maybe 5% of their total revenue in fiscal year 2023, its remarkable 59% year-over-year growth in Q2 2025 shows immense, almost explosive potential.
This is a stable, high-margin area. that directly and powerfully offsets the inherent volatility and cyclicality of the consumer phone market. It's not just about selling individual chips. It's about powering the entire digital chassis of the modern vehicle. From Snapdragon Ride for autonomous driving, Snapdragon Auto Connectivity for seamless internet, Snapdragon Cockpit for immersive in-car experiences. The strategic acquisition of Autotalks for V2X communication further cements their position at the core of future smart, connected transportation, enabling vehicles to communicate with each other and infrastructure for enhanced safety and efficiency. This market offers predictable, long-term design wins, high content value per vehicle, making it an undeniable cornerstone of Qualcomm's bullish outlook, promising durable, consistent revenue for years to come. And beyond automotive, the expansion into AI PCs and the broader Internet of Things represents truly untapped opportunities that are just beginning to unfold. The Snapdragon X Elite processors aren't just another chip in the crowded PC market. They offer clear, tangible advantages in power efficiency and unparalleled on-device AI processing. This translates directly into real-world benefits for consumers, like enabling multi-day battery life for laptops, a significant differentiator in a market hungry for innovation, especially for mobile professionals, students. And this isn't just a niche product. It's already capturing approximately 9% of the premium Windows laptop market in the US and key European countries in Q1 2025. A strong, impressive start against deeply entrenched competitors like Intel. The IoT segment, with its impressive 27% year-over-year growth in Q2, is a launchpad into an ever-expanding array of new device categories: smart cameras, industrial robots, wearables, enterprise solutions, further enhancing edge AI capabilities and expanding their footprint across industrial, consumer, and enterprise IoT. And looking further out, their planned acquisition of Alphawave Semi for $2.4 billion for high-speed connectivity. That seems like a masterstroke of strategic foresight to me. This move directly targets the massive high-margin data center market, where the surging global demand for AI infrastructure requires increasingly high-speed, efficient data transfer solutions. This is not just diversification for the sake of it. It's strategic, calculated positioning in the absolute highest growth areas of technology, ensuring Qualcomm is not merely participating, but actively leading in the next wave of computing and connectivity, leveraging their core expertise into new lucrative domains. What's truly compelling here as well is how Qualcomm's strategic execution in these high-growth areas is powerfully reinforcing its underlying financial strength and its robust commitment to rewarding shareholders. With a trailing price-to-earnings, or PE, ratio of approximately 16, the stock's valuation suggests, perhaps, that the market may not yet be fully pricing in these durable high-growth revenue streams from automotive, AI PCs, and the expanding IoT segments. From my perspective, this still looks like potentially an attractive entry point for long-term investors who can see beyond the current, maybe negative, mobile market sentiment. Wall Street analysts have certainly taken note of this underlying strength. The consensus 12-month analyst price target stands at $179.50, implying an encouraging 11.5% upside potential from current levels.
Bernstein analyst Stacy Razgon, a prominent voice in semis, recently reiterated a definitive buy rating on QCOM with an even higher $185 target. Razgon explicitly acknowledges and kind of dismisses what he calls smartphone distaste and tariff pressures, instead emphasizing the fundamental strength and long-term potential of Qualcomm's strong product portfolio and strategic pivots. KeyBank analysts also project upside in the upcoming June quarter, further reinforcing this positive sentiment. But beyond analyst ratings, management's concrete actions really speak volumes, don't they? The company offers a healthy dividend, yielding around 2.25%, providing a consistent, tangible return. More importantly, their explicit commitment to returning 100% of their free cash flow to shareholders in fiscal 2025 is a powerful statement of belief in their long-term cash-generating power. This signals management anticipates ample, sustained free cash flow from core ops and rapidly growing new areas, which they intend to directly share with owners, underlining their confidence in the company's financial future. This is the kind of financial discipline and unwavering confidence that powerfully underpins a strong bull case.
Okay, however, despite all those admirable diversification efforts and the promising growth segments you've outlined, if we connect this back to the bigger picture, Qualcomm's revenue, unfortunately, remains heavily critically dependent on the smartphone market still. In fiscal year 2023, the mobile business alone contributed over 60% of their total revenue. Over 60%. This is a crucial vulnerability because the global smartphone market has been in what many analysts termed a protracted winter period, experiencing a challenging stretch with 27 consecutive months of year-on-year declines. That clearly highlights the inherent cyclicality and, frankly, maturity of this industry. While there are some recent signs of a rebound, yes, with that modest 5% year-on-year growth observed in October 2023, the sustainability of this upturn remains uncertain. It requires continued, careful observation before declaring a definitive recovery, I think. This heavy reliance on a mature, cyclical, fiercely competitive industry makes Qualcomm inherently vulnerable to any significant shifts in consumer demand, broader economic downturns, or intensified competitive pressures within the mobile space. This very reliance was a primary reason for that stark 27% year-on-year decline in mobile business revenue for Q4 fiscal year 2023. And it directly contributed to the company experiencing 4 consecutive quarters of overall revenue and EPS decline throughout fiscal year 2023. So while recent premium Android wins are positive, yes, the foundation of their revenue still rests significantly on a segment that has demonstrated considerable weakness and unpredictability. That's just a fact. And this brings us to another significant challenge. The competitive landscape in mobile chipsets is incredibly intense. It's not just about market share percentages, it's about the very core profitability of their business. While Qualcomm is undoubtedly a leader, MediaTek holds a very close 30% market share in shipments, just slightly ahead of Qualcomm's 29% in Q2 2023. This isn't a static market, it's a constant, aggressive battle for dominance, especially in the mid-range. More critically, Qualcomm itself has publicly admitted a projected decline in the market share of a major customer's product line in the fall of 2025. This, of course, refers to Apple, which has been aggressively reducing its reliance on Qualcomm's modems by designing and producing its own in-house modems for iPhones and iPads. Losing a major customer like Apple, especially one contributing so significantly to the highly profitable premium tier of their mobile business, is a severe and direct threat to Qualcomm's future revenue and margins. This isn't just ensuring a continuous, intense battle for market share and innovation. This constant pressure on market share across multiple fronts could undeniably erode profitability and make sustained growth more challenging, even in their promising new segments. And beyond direct competition and market specifics, there are broader macroeconomic and geopolitical risks that warrant careful, prudent consideration for Qualcomm. Qualcomm itself acknowledges significant uncertainty regarding the financial impact of global tariffs. They recognize it as a dynamic, evolving area with substantial potential future implications, especially given the complexities of international trade dynamics. Any escalation of existing tariffs or the introduction of new trade barriers could disrupt their intricate global supply chains, significantly increase their costs, or directly impact demand in key international markets, particularly China, where a significant portion of their business is concentrated. Moreover, despite exceeding Q2 expectations, Qualcomm's Q3 fiscal 2025 revenue guidance, $9.9 billion to $10.7 billion, was perceived by many analysts as lower than the market's midpoint expectation of $10.35 billion. This cautious outlook, immediately after a strong earnings beat, caused the stock to drop after hours on the earnings release, indicating investor sensitivity to forward guidance and any hint of future headwinds. Management explicitly cited macroeconomic uncertainty in the global trade environment as significant factors influencing this guidance, underscoring that these external elements aren't just theoretical risks, they are active, tangible considerations influencing their immediate future performance. This cautious outlook, combined with what TipRank's AI analyst cautioned as overbought technical signals, suggests that short-term pressures and broader external factors could still weigh heavily on performance and investor sentiment. Indeed, Bernstein analyst Stacy Rasgon also noted, ahead of Q3 earnings, that Qualcomm remains heavily out of favor amid general distaste of smartphones, tariff pressures, muted expectations over the near term due to Apple's use of its in-house modem chips, and a lack of catalysts currently. This paints a picture of a company facing a confluence of significant, ongoing, multifaceted challenges that require vigilant monitoring.
Right. So with all this dynamic interplay between opportunity and risk, what does this all mean for you, the listener, looking ahead? Well, Qualcomm is scheduled to announce its results for the third quarter of fiscal 2025 after the market closes on Wednesday, July 30th. This report will be a truly critical checkpoint, a litmus test maybe, for validating the momentum of their diversification strategy, especially given some of the headwinds we meticulously discussed. Wall Street analysts are already setting their expectations. The consensus forecast is for an adjusted EPS of $2.71, which, if achieved, would represent a respectable 16.3% year-over-year growth. Revenue is anticipated to come in at $10.34 billion, reflecting a 10.1% increase year-over-year. The company's own guidance for this period, which they issued back on April 30th, was for revenue between $9.90 billion and $10.7 billion, and adjusted EPS between $2.60 and $2.80. So the street's expectations are right within the projected range, though leaning slightly towards the midpoint. It'll be incredibly interesting to see how closely they hit these targets, particularly as a reflection of those new growth engines.
And for those closely watching the stock, maybe preparing for potential volatility, options traders are already anticipating about a 6.45% move in either direction for Qualcomm stock immediately after the Q3 results are announced. That reflects a significant degree of uncertainty and volatility surrounding this upcoming report, highlighting just how much is riding on these numbers and the accompanying management commentary regarding future outlooks and market conditions.
Exactly. And to truly understand if Qualcomm's diversification story is maintaining momentum, if the narrative of turning the corner really holds true, you'll want to pay close attention to specific metrics beyond just the headline numbers. Firstly, look for continued double-digit year-over-year revenue growth in both the automotive and IoT segments. These are the acknowledged future growth engines. Their sustained, strong expansion is absolutely critical to successfully reducing that historical reliance on the mobile market. Secondly, stable or, ideally, improving QCT handset margins will be a key indicator. This will confirm that Qualcomm is not only holding, but maybe solidifying its leadership in the profitable premium Android tier, which remains a crucial traditional stronghold despite diversification. If those margins show witness, it could signal renewed pressures in their core mobile chip business, even with those premium tier wins. Lastly, listen very closely to management's outlook commentary, particularly on the design win pipelines for the PC and automotive segments. This will provide a vital window into future revenue and sustained strategic success. Listen for concrete details. New contracts, expanded partnerships, specific product integrations, these are tangible, forward-looking signs of future revenue and sustained strategic success. As of now, the consensus rating for QSAM on Wall Street is a moderate buy. That's based on 8 buy recommendations, 9 hold recommendations, and 1 sell. So a mixed bag, really. The average QCM stock price target is $179.50, indicating about 11.5% upside potential from current levels. Year-to-date, QCM stock has risen about 5%, showing some positive momentum, but also reflecting the highly nuanced and mixed perspective currently held by analysts who are weighing both the opportunities and the risks we've discussed today.
Yeah, it really seems like Qualcomm's journey is a classic example of a company adapting and evolving in what is just a fiercely competitive, rapidly changing tech landscape. Their strategic execution, particularly in diversifying beyond their traditional mobile stronghold, has definitely set them on a clear path to becoming a more balanced and truly diversified technology leader. While their foundational legacy is undeniably mobile communications, their future is actively being engineered in our cars, on our desks, through AI PCs, and increasingly across the intelligent enterprise. From my perspective, it's a deeply compelling long-term growth story that, even with the bumps in the road and the inherent challenges of a dynamic market, is maybe just getting started as they leverage their foundational IP and chip expertise into these new high-growth markets.
Indeed. The Q2 2025 results, they show clear promise in their diversification efforts, particularly in automotive and IoT, which are becoming increasingly significant revenue drivers for the company. No doubt about that. Yet, the persistent dependence on the cyclical smartphone market, the intense competitive pressures from rivals like MediaTek, and especially those strategic shifts from major customers like Apple, well, alongside broader global trade uncertainties, they underscore that vigilance remains absolutely key for investors. So the question for you, the astute learner listening in, is this. In an era where everything is smart and connected and AI is becoming pervasive at every level of computing, can Qualcomm's foundational technology and its unique licensing model truly maintain its competitive edge across this vastly expanded technological landscape? Or will the very diversification it vigorously pursues eventually lead to new, perhaps unforeseen challenges from an even broader array of formidable competitors in every single new market it enters? Something to think about.
Absolutely. And before we sign off, just a crucial reminder for everyone listening. The information presented in this deep dive is strictly for informational and educational purposes only. It does not constitute a recommendation or endorsement of any specific investment or investment strategy. You should always consider the appropriateness of this information, having regard to your relevant personal circumstances before making any investment decisions. Investment information is general in nature. It's strictly for illustrative purposes, and it may not be appropriate for all investors. Past investment performance does not indicate or guarantee future success. Returns will vary, and all investments carry risks, including the potential loss of principal.
Furthermore, the responsibility for your investment judgments and decisions rests solely and entirely with you. It's also important to note that parts of the source material we analyzed for this deep dive were generated by AI. While we always strive for accuracy in our analysis and distillation, the content of AI-generated information cannot be fully guaranteed for completeness or absolute accuracy. always, always refer to official company investor relations websites and comprehensive financial reports for the most complete and accurate details. Thank you for joining us on the Deep Dive.